Your house isn't making you rich, it's keeping you broke. Here's the math the banks don't want you to see. Most people think buying a house is the smartest financial decision they will ever make, building equity, investing in their future, the American dream. But the math tells a different story. A $400,000 house doesn't cost $400,000. It costs over $1 million, and it generates zero cash flow. Welcome to the mortgage trap. Let's run the real numbers. You buy a $400,000 house. You put down 20%, that's $80,000. You finance $320,000 at 7% interest for 30 years. Your monthly payment is $2,661. Seems manageable, right? But over 30 years, you will pay back $958,000. You borrowed $320,000. You're paying back $958,000. That's $558,000 in pure interest, more than the house originally cost. But that's just the mortgage. Add property taxes, $6,000 a year, that's $180,000 over 30 years. Homeowners insurance, $2,000 a year, another $60,000. Maintenance and repairs at a conservative 1% annually, $4,000 a year, that's $120,000. Don't forget closing costs. $20,000 when you bought, and another $24,000 in realtor fees when you sell. So add it all up, the mortgage, taxes, insurance, maintenance, closing costs, the grand total for your $400,000 house is $1,362,000. You paid 3.4 times the sticker price. And here's the trap. That entire time, the house generated zero income. Zero. Every single month, money just flowed out. Mortgage, taxes, insurance, repairs, out, out, out. Nothing ever came in. This brings us to Robert Kiyosaki's simple definition from Rich Dad, Poor Dad. An asset puts money in your pocket. A liability takes money out. Your primary residence takes money out every single month. Mortgage, taxes, insurance, maintenance. By definition, it's a liability, not an asset. We've been taught our whole lives that a house is an investment that makes you rich. The banks love that you believe this. But what about building equity? Are you really? For the first 10 years of a 30-year mortgage, 75% of your payment goes straight to interest. Only 25% hits the principal. You're barely touching the loan. You're just paying the bank. And since the average American moves every 7 years, you never even reach the phase where you're building significant equity. You sell, pay realtor fees and closing costs, move, and start the cycle of paying mostly interest all over again. People say renting is throwing money away. Is it? Your mortgage interest is thrown away. Property taxes, thrown away. Insurance, maintenance, all thrown away. You never get that back. At least with rent, you know your exact cost. No surprise $15,000 roof replacement or an $8,000 HVAC failure. The landlord handles that. You have a fixed cost and flexibility. Now for the part nobody talks about, opportunity cost. That $80,000 down payment, what if you invested it in index funds instead? At an average 8% return, over 30 years, it becomes $693,000. But that money is now locked in your house. Illiquid. You can't touch it without selling or taking on more debt. You gave up almost $700,000 in potential returns. And then there is mobility. You get a job offer in another city. Better pay, better opportunity. But you own a house. Selling takes months. Realtor fees are 6%. Closing costs. If the market is down, you might lose money. So you stay. You turn down the opportunity. Your house trapped you. Renters can move in 30 days. They have flexibility. They can chase opportunities. Homeowners are stuck.
Here's the rent versus buy comparison nobody ever shows you. Let's use real numbers. Scenario 1. You buy that $400,000 house. You put $80,000 down. Your monthly mortgage plus property taxes, insurance, and maintenance comes out to about $3,200 a month. Over 30 years, you spend $1,362,000. At the end, you own a house, and you hope it appreciated. Now, scenario 2. You rent for $2,000 a month. You take that same $80,000 down payment and invest it in index funds. Then you take the monthly difference, the $1,200 you're saving because your rent is cheaper than the mortgage payment, and you invest that every single month. At an average 8% return over 30 years, here's what happens. Your initial $80,000 grows to over $690,000. Your monthly investment of $1,200 grows to over $1 million. Your total portfolio? $1,739,000. Liquid, diversified, and accessible. The renter who invested ended up with nearly $400,000 more in wealth than the homeowner, and the renter had complete flexibility that entire time. They could move for a new job, no surprise maintenance bills, no shocking property tax increases. This is the math they don't want you to see, because an entire industry makes billions convincing you that renting is throwing money away. It's not always true. Now, that doesn't mean you should never buy. Buying can make sense, but only if you meet certain criteria. Ask yourself, do you plan to stay in one place for at least 10 years? Is your income stable? Will the total mortgage payment be less than 30% of your income? Do you have a 6-month emergency fund after making the down payment? And most importantly, do you understand you are buying a lifestyle, not an investment? If you can check all those boxes, buying can be a great decision for stability and control. But here's what you should never do. Never buy a house because you think it will make you rich. Never buy because someone told you renting is throwing money away. Never buy because you feel pressured. Never stretch your budget. And never, ever skip your emergency fund to scrape together a down payment. If you buy for the wrong reasons, you'll end up house poor, trapped by a mortgage payment with no money left to invest or save. So what do the wealthy do? They don't treat their primary residence as an investment. They buy rental properties. A true rental property is an asset. Your tenant's rent covers the mortgage, taxes, insurance, and maintenance, and still puts cash in your pocket every month. That is an asset. The property appreciates, you get tax benefits, and the tenant pays down your mortgage for you. That's how real estate actually builds wealth. The wealthy either rent their primary home or buy something modest. Then they use their capital to buy assets that generate cash flow. Rental properties, index funds, businesses. They don't tie up all their money in a house they live in that generates zero income. Here's the bottom line. Your primary residence is a place to live. It's not a financial tool designed to make you wealthy. You are spending money on housing just like a renter. The key difference is that the disciplined renter can invest the savings and often end up with more wealth. The mortgage trap is real. It's a system of locked capital and limited mobility. Run the numbers yourself. Factor in the opportunity cost of that down payment, and then make the decision that's actually right for you, not the one everyone tells you to make.